what we're going to talk about today is the super investor cheat code. What that simply is the exact strategy I've been able to implement to scale my portfolio from just a handful of properties. My portfolio is like over $23 million today, and I've done that in less than 2 years. So I'll break down my journey and all that kind of good stuff, but I wanted to really highlight the super investor cheat code, exactly what has allowed me to scale so quickly and get so much results in such a short time frame. The huge emphasis of that is the co-living rental strategy. So I'm going to provide an entire masterclass on co-living and then touch on components of the super investor cheat code so that you can scale your way to financial freedom. You shouldn't watch this stuff to just see what I'm doing and just think like, oh, okay, that's cool. Like, I love that for him or whatever. Like, the only reason why I share all this stuff is so that you can then go ahead and implement. I share my journey. I share my results. I share the wins, the losses. I share all of that. Not for me, like, why would I care? It's for you to then take that information and then implement it in your own investing journey if you truly are committed to financial freedom. Because the thing I've learned over the last couple of years is there are so many paths to financial freedom, and real estate is one of the best ones. And the way that I've been able to go about it, basically leveraging the super investor cheat code, has allowed me to get way higher returns with way less time and have way better cash flow, have way better ownership benefits, all of this good stuff. And I really want to share that with you guys today. So, all right, so we're going to cover today. We're going to touch on the super investor cheat code. I'm going to break down in detail why co-living is the best rental strategy. We're going to talk about how you can choose your own investing market and properties that make the most sense for that market, and the cost to buy a co-living rental, how that varies from like a traditional rental, and the different costs associated with owning a co-living property. So with that, let's get right into it. Real briefly, who am I? Michael Manatskanian. I own Coast to Coast Vets, which is my real estate investing business, as well as Super Investors, which is everything in regards to the education and free value I put out there. I do have a mastermind community called Super Investors, but that encompasses all of the 95+% of free content that I put out there as well. So my free wealth to real estate community, all this YouTube content, everything falls under Super Investors. It's the education arm of my business, the thing I am really extremely passionate about, the thing that I was doing since I started my journey, and the thing I'm really happy to help other people do, which is help them achieve financial freedom, understanding that all I can do is take my Army veteran, engineering, real estate investor brain and try to share these things with you guys, but I cannot push you to success. You have to do it all. All I can do and all I try to do is provide you as much guidance as I possibly can based on my own experience, as well as working with lots of mentors and other real estate investors, so that you can fast track your path to financial freedom. That's really what I'm here to do, provide you that support, whether it's for free in the variety of ways that I do so, including this kind of stuff, or even through my paid Super Investors community. Just understand, my goal is to provide you as much value as possible so that you can succeed in your own journey. I can't force you to, but I can help you as much as I possibly can through education, tools, resources, all that good stuff. The number one thing you should know about me is that my family is the most important thing to me. My wife, my baby girl, so my beautiful wife, Sierra, who we've been high school sweethearts, my baby girl, Mila, who's around 15 months old right now, and then little baby boy on the way in a couple months. My family is my everything. The reason why I started all this and the reason why I worked so hard in my 20s to become financially free before I hit 30 was all for my family. I come from a broken, poor, low income upbringing. First generation American, mom had to work multiple jobs as a single mother to take care of us. I appreciate everything she did to get us to where we're at. However, I learned that I did not want to bring kids into this world if I was not able to financially support them, and more importantly, be as present as possible with them for the moments that matter the most. I wanted control of that. I didn't want a job to dictate that for me. So I've always been very passionate about achieving that financial freedom. I just didn't know how. And in my early 20s is when I started learning about real estate investing, and it changed everything for me, changed my entire course from, okay, I'm going to work a job, right? I was in the Army when I really started taking real estate investing seriously. I decided to be a chemical engineer while at school so I can make more income, so I can invest that and then put it into stocks and let it grow over 40 years. Then I learned about real estate and I realized, oh my God, I can get the same results, even better results in way less time. Why would I not go this route, right? But the difference is you have to be much more educated in real estate investing because there's more risk. than just putting money passively in the stock market. I'm not here to tell you what route to go. Well, obviously real estate, right? That's my route. But I also put money in the stock market. I like a diversified portfolio. Regardless, I'm an Army veteran. I'm an engineer by trade. I studied chemical engineering and finance at UC San Diego, and I've been in the real estate investing space since 2018. I currently hold over 70 rental properties. I've done additionally at least 100 additional transactions as a wholesaler or bird dog, which basically means I got very good at finding great investments that investors want to buy. That is a skill set of mine. Looking at investments, quickly determining what makes sense and doesn't, analyzing those, and then making sure I connect that to the right buyer, including myself, who's bought a ton of these deals. Since I started my investing journey in 2020, which I'll break down briefly, I bought over $23 million of real estate, and the majority of my portfolio has been purchased in the last 2 years. So from mid quarter one, 2023 until quarter one, 2025. So that 2-year time span is where the majority of my real estate has been purchased. And almost entirely it has been purchased through creative financing, raising capital to fund my deals. So buying them using none of my own money, and leveraging the co-living property management strategy. I own in over a dozen states. Majority of my co-living properties are in the Southeast. I love the Southeast in particular, Texas and Colorado. Colorado is a great co-living market. I currently own over 100 co-living rentals. I've raised over $6 million through private money lenders and partners so that we can buy deals together. And I've also done over $2 million of capital raising on the fractional platform to allow co-ownership. So going to own 100 co-living units with me through that $2 million of capital raise in 3 different projects. So this is part of my further commitment. It takes me more time and effort to co-own assets with lots of people, but I go out of my way to do so that more people can have ownership and fast track their path to financial freedom. This is when I say super investors. I have a paid mentorship. I have all that. You more likely are not the right fit for it. Maybe you are. I don't know. We'll have to figure that out later. But what I do want you to understand is I'm trying to put out so much freaking content, trying to Hermosi the heck out of putting out as much free content out there as possible for aspiring real estate investors so that you can fast track your path to financial freedom. That's literally my goal. So let's talk about that very simply. If you've been through any of my trainings, you know this is a visual that I use all the time because I think most people don't even fully comprehend what it means to be financially free through real estate. And this comes after talking to dozens, if not hundreds, maybe even close to 1,000 real estate investors, and understanding that a lot of people in the space don't even really understand how real estate makes them financially free. The most straightforward path for becoming financially free through real estate, and understand what financial freedom is. Let's define that. Financial freedom is when you have more money coming in every month passively than you spend. So if you're spending $5,000 a month, you are financially free if you can generate over $5,000 a month passively through your investments. I say passively, but the term should be semi-passive. Real estate is not passive as in you set it and forget it, like investing in an index fund, but it is passive in the sense that once you do a lot of the startup work, you can then hire and outsource a lot of it. And like myself, put in 5 to 10 hours a week tops to own and manage a massive portfolio. And for most people, you're not going to need 70 plus rentals or 20 plus $1 million of real estate. With just a few $1 million or a couple properties, you can be fully financially free for the entirety of your life through real estate investing. When I say a couple $1 million, I'm talking about owning those assets. You don't need a couple $1 million to start. I've generated my entire portfolio leveraging other people's money and debt. So with that definition, financial freedom is when you have more passive income, aka cash flow, coming in from your rentals than you spend. That is your goal, and that is the way that you should consider being financially free through real estate. Additionally, there are a lot of other benefits to real estate investing that you cannot get through any other investment strategy. One of the other ones that directly contribute to your financial freedom is tax savings. So me making $100,000 in a job versus me making $100,000 in the stock market versus me making $100,000 in real estate are all vastly different. At a job, you are paying the maximum amount of taxes. Through the stock market, you're paying substantially less, but you're still paying, if it's long-term capital gains tax, like 15% of that towards taxes. Through real estate, whatever you make, as long as you have the right CPA who understands what you're doing, it's not H&R Block probably won't do this for you, but you have a CPA who understands taxes for real estate investing, you can keep all of your freaking money. The $100,000 I make in my job that ends up being 60,000 by the time it's all said and done, or the 100,000 I make in the stock market that ends up being $85,000. Well, $100,000 in real estate is $100,000 for me to live off of, for me to use. So it's not just the amount of money that you're making, it's also more importantly how much money you are keeping. Those two directly contribute to your financial freedom. Why I have those highlighted for financial freedom here. Those are the most straightforward ways to become financially free. Get more cash flow coming in every month through your rental properties. Then you are spending, you are financially free. There are a tremendous amount of wealth benefits to real estate investing as well. Those are your ownership benefits. Your property over time is increasing in value. It has always increased in value over time, and it exceeds the rate of inflation and all that good stuff. So it's always growing in value, and that is adding to your net worth. That property went from $100,000 to $150,000. That extra $50,000 has been added to your net worth. You are $50,000 more wealthy. If you were to go and sell that property or refinance that property, you can pull that money out, right? So that's building your wealth. That can also help you with financial freedom, but it takes more time to allow for that appreciation to occur. And you don't want to bank your financial freedom on appreciation. You want to get there through cash flow. Additionally, when you own a property, the way the income flows is your tenant pays rent, you take that rent and you pay your debts and other expenses, and whatever's left over is your cash flow. That's what you can live off of. Well, did you hear that first part? You take the income from your tenants and you pay down your debts. Your tenants' rental income that you're receiving is paying down your debts. Your tenants are paying down your debts for you. A portion of that debt is interest. That interest is a tax deduction, but a lot of it also is principal pay down. They're physically paying down your debt. Remember, we bought a property at $100,000. It was worth $150,000, let's say 10 years later, but the debt went from $100,000 to $50,000, right? So your equity spread, the property value minus the debt, is now $100,000. $50,000 from appreciation, $50,000 from debt pay down. That is your wealth now is $100,000. Once again, you can tap into that through selling it, refinancing it, whatever you want to do, you can tap into that through those routes. Once again, that is a wealth builder. An additional benefit to real estate investing that you cannot get virtually anywhere else except maybe businesses is leverage. This is not like a direct return that you get, but it's one of the biggest advantages of real estate investing compared to any other asset class you can invest in. First, you can take out debt. You can use other people's money, primarily the banks, to buy rental properties with little to none of your own money. You can use, like when I started, you can use house hacking. So buying a property and living in a unit and renting out to others. For me as a veteran, 0% down. You can also do a 3.5% down or 5% down FHA loan or conventional loan. Even a 20% down payment can get you ownership of a $100,000 asset, right? $20K to get ownership of a $100,000 asset that generates you cash flow, appreciation, debt pay down. There's virtually like none of that out there otherwise. Other people's money. This is when you start taking things to the next level. So that $20,000 you needed to put down to buy the property, an additional $10,000 to renovate it, well, that doesn't need to come from me. That can come from capital partners, people who have money that want to be more passive investors. They bring the money, I bring the deal, and I operate it. They're bringing the money for me to then buy these assets using none of my own money. That's exactly what I've done over the last 2.5 years to then scale my portfolio. If I had to be dependent on my military, like army, and then government salary to do so, there's just no way. Even in my entire lifetime, I cannot have earned and saved $5 million to build my portfolio. I had to do it through leveraging other people's money. That's one of the ultimate cheat codes. I'll be breaking that down shortly. And another benefit in regards to leverage is momentum. As you are doing more and more real estate, you are more and more knowledgeable, more and more people know you, you have a better track record, you have better experience, better successes, and all that benefits your ability to go find better deals, more deals, better deals. You understand a lot more, and it's easier to raise money for those deals. So that's another massive benefit that I attribute to leverage in real estate investing. It makes the whole process easier. And as you grow and scale, it only becomes easier to do real estate. The first property you buy is going to be the hardest. The first time you raise money, it's going to be the hardest. The first co-living rental you buy is going to be the hardest. Everything gets easier with time, especially when it comes to capital raising and getting better deals. So with that, very simply understand that you become financially free through real estate, through your cash flow, and because it's real estate investing, you get to keep all that money. You're not wasting money on taxes. My very succinct path to financial freedom. 2018 is when I started learning about real estate. It took me over 2 years of paralysis by analysis. So just learning and podcasts and books and underwriting and spreadsheets and this and that to buy my first property. What really changed things for me was surrounding myself around other investors who were doing the thing that I wanted to, comparing my numbers to theirs and realizing, okay, I've got a pretty good grasp of these numbers, but they have the assets. They have the properties that are generating them cash flow. So what do I need to do? I need to start making offers. I need to stop being afraid to take the next step. I was analyzing deals. I was not making offers because I was afraid of if they accept my offer, I don't know what to expect moving forward. Well, I gave myself an ultimatum and said, either I make an offer on the next property that makes sense, or I stop pretending to be a real estate investor. You need a learning phase of your journey. Most people get stuck in the learning and never actually take the action needed to buy a property. I was in that exact same position, which is why I gave myself an ultimatum and I pulled the trigger and a lot of things went wrong. I figured it all out, just like you will as well. You should believe in yourself. You should have confidence. That is courage, right? Courage is being confident in your ability to figure things out. Doesn't mean you're going to know everything or you can anticipate everything. But what you can do is have the confidence that you will figure it out when things come up. When there's a random plumbing leak during your inspection, or you have pipes freezing, like for me in Alaska, or you need to negotiate with the seller while it's already under contract, like you will figure those things out. And when you need to renovate for the first time, when you need to list your property for the first time, create your first lease, have your first tenant, you will figure all those things out with time because that will be your focus at that time. You have to be confident in your ability that you will figure it out. That was my biggest issue, in surrounding myself with other investors gave me all the confidence that I needed, because even if I didn't know everything, I knew I could tap into books online and local investors, as well as just other real estate investors who have done the thing that can help me out if needed, right? That was the light bulb moment for me. After that, I started learning about off-market deal finding, a little bit of creative financing. And the next year I bought my next small multifamily property in 2021. This was a 4-unit instead of a 2-unit. Additionally, I started finding deals off market for other investors. I was bird dogging and wholesaling for other investors. And I started doing that for myself. As I was learning about seller financing, I started reaching out to sellers that own properties outright that could potentially provide me seller financing opportunities, and bought 20 rental cabins. So in 2020 to 2021, in a 13-month period, I went from one property, which was 2 units, to my second property, which was 4 units, and then 20 rental cabins after that. Virtually little to none of my own money, leveraging, creative financing and house hacking. And at that point, I was financially free. At that point, I had more money coming in every single month than I was spending. At that point, by September of 2021, I was essentially done. Well, that's not the way I operate, but what I decided to do is get out of the military. At that point, I said, hey, at the end of my 4 years, I'm done. I'm getting out. And what I did was I leveraged another small multifamily house hack at the end of 2022. That was my real estate investing journey from 2018 to 2022. Things took a massive leap when I started getting better educated through the Sub2 mentorship and my mentor, Pace Morby. And I started learning, but more importantly, implementing things that I was learning through that community as well as elsewhere. I'm a very proactive learner. And I think of things in like systems and a reverse, it's the engineer in me, right? I think, okay, if this is the result that I want, how can I get more of that more quickly, more efficiently, less bottlenecks? What can I automate? What can I streamline? That's just the way I operate. And it's a massive advantage because now you all get to benefit from it, because that led to me creating the Super Investor Blueprint, a very step-by-step systematic process for scaling to financial freedom as quickly as possible. So at that point, I had a couple rentals worth less than $2 million. 2023 till now, I've scaled additional $21 million of real estate. And understand this, $21 million is based on my acquisition costs, right? The property values have increased substantially since 2023. I have one property in San Diego alone that's increased several $100,000. I have another one in Savannah, Georgia that we got an appraisal on, and it was $200,000 more than I anticipated. So there's a lot more equity buildup. I don't even account for that in these numbers because that is cool for flexing, I guess. I have a big portfolio. I've got a lot of wealth, whatever. But the real thing that makes the difference is how much money am I making each month in cash flow? How much could I be spending or reinvesting in other things? At this point, I have way more money coming in through real estate than I spend monthly, which is great. That's the position you want to be in, especially someone who's younger, because I got another kid on the way. I still got so much life ahead of me. I want to have more money coming in than I spend because my lifestyle will inflate over the next couple decades. All right. That's my path to financial freedom. house hacking, learning off market deal finding, and then leveling up massively through mentorship, but most importantly, creating my super investor blueprint and going all in on it. Once again, when I started it, I didn't think I have the perfect blueprint. I was just doing things that made a lot of sense. And then I started implementing it and improving it. That was the big thing. I implemented it, I improved it, I re-implemented it, I improved it. I continued down that path to what I feel like is one of the most perfect investment strategies, especially in this day and age, in today's market. A lot of people will tell you things that worked for them. I could tell you what worked for me in 2020. I can tell you what worked for me in 2021 where interest rates were super low, buying on-market properties, whatever. Like I can tell you those things. But most of those guys who are still educating in that way, they haven't bought real estate, especially not a substantial amount, in the last several years. When the market shifted, interest rates went up, their lame strategies no longer work for them. Cool. They can't adapt. They fail. They fall out, right? What I've done is not just grow my portfolio, but I've massively scaled it and educated so many other people on how they can do the same. That should be the most important thing from you when you're trying to learn from someone. Are they doing the thing that you want to do? And are they still actively doing the thing that they're educating you on? A lot of people educate you on things that they used to do that used to work for them. Cool. That's also kind of meaningless. What matters is what is working today, right now. I've bought, using the Super Investor Blueprint, just this year alone, I bought several million more of real estate. Using none amount of money, I've raised over $1 million to do so. Like, it's still actively, it's the thing that I am doing. We just raised another $700,000. We're going to buy at least 5 more co-living rentals in the next 2 months. So like, learn from the people that are doing the thing that you want to do and that are still actively doing it. That's my piece of advice. So what is the Super Investor cheat code? If I was you, I'd screenshot it, I'd share it, I'd freaking whatever. But the Super Investor cheat code, very simply, is buy properties leveraging creative financing, raise capital to buy those deals so your money is no longer a bottleneck, and leverage the co-living management strategy so you get way better returns, there are way more properties that make sense, and you're building more wealth per asset, right? I'm going to break this down in further detail over the next couple of slides, but the Super Investor cheat code, creative financing, capital raising, and co-living. So 3 C's. All right. So for those of you who don't know what co-living is, I'm going to very briefly touch on it. Very straightforward. You'll understand it like that. Co-living investing is buying a property, typically just a house, right? And then renting it out by the room. You go buy a 4-bed, 3-bath house and you rent it out by the room, right? You have 4 bedrooms that you can rent out. However, the most common way that co-living investors operate is that we're not just taking a 4-bed, 3-bath house and renting that out by the room. We're converting common areas into additional bedrooms. There's a lot of properties that are 2,000 square foot or larger that have a living room and a dining room and an office and game room, and like they have massive master suite. You take all the extra areas that you can and you convert them into bedrooms without compromising quality of life for your tenants, right? And I'll talk about what that looks like for the conversion, but you want to at least ensure that you have a kitchen for your tenants, so for those that want to cook. And it's fully up to you how many common areas you want to have. There is a massive spectrum when it comes to co-living investing. Some people never convert anything. They just buy it as is, and that's that. If your goal is to have a solid balance between maximizing your returns and quality of life for your tenants, you're going to end up with properties that are between 7 to 9 bedrooms, or at least 3 bathrooms. That's going to be the sweet spot. 7 to 9 bedrooms with at least 3 bathrooms. That's kind of where you're going to want to end up with a lot of your properties. For someone who doesn't understand, I'll get way more into detail, but why would someone want to invest in co-living opposed to other strategies? Well, you get way higher income than you would through traditional rentals, way lower vacancy through shared housing. So when you have a single family home, if that property is vacant, or a short-term rental or mid-term rental, if you don't have a tenant in there, that property is vacant, you make no income. Well, if I have a vacancy in a co-living rental, cool, 1 or 2 or 3 or 4 of my rooms are vacant out of the 9 rooms, right? So it's not like I'm making less income, but I'm not making no income. And usually around 4 bedrooms will allow you to cover all of your expenses and mortgage. So that's a huge freaking thing to think about when it comes to co-living investing. Additionally, you're able to provide affordable living for your tenants. And as an investor, once again, I'm an investor, right? I reverse engineered to this point. I love that I get to provide affordable housing to my tenants, right? A lower cost option than is otherwise available in the major markets that we operate in. However, I do it because we get way better returns. I'm able to get more cash flow and better ownership or wealth benefits by buying bigger and better properties in better locations. right? I am an investor. You guys are investors. I would assume you're watching this because you want to understand investing. That's why. So let's get into it, right? Like a lot of times people see this and they say, a single family home, and you rent out by the room, and people want to live like that. Well, first of all, it's very common globally, and it's more and more common in the States. And I'm going to kind of break what that looks like and why is now like the perfect storm for it. Here is a housing unaffordability forecast. I'm not going to get into every single detail here, but the chart on the right is essentially showing you how many housing units there are available, how many houses are available for people to buy relative to the number of people looking for housing, right? In this chart alone, as of 2022, there was a 3.2 million shortage. Depending on what stats you look at, there's between 3.8 to 5.5 million shortage of people that want to buy houses compared to the amount of houses that are available for them to buy. Additionally, there is a shortage of over 1 million rental units. So it's not just those that are looking to buy properties, but those that are looking to rent, there is a massive shortage. Well, if you understand supply and demand, when there is less supply of housing than the demand that's needed, prices go up, right? That's a big factor in there. A big reason for that, I'm going to blame policies. I'm going to blame local policy. I'm going to blame government, zoning restrictions, rent control, permitting delays. There is a limitation on creating this housing. Additionally, between higher interest rates and higher housing prices, right? Interest rates were really low 2019, 2020, 2021, started shifting in 2022. Well, when interest rates are really low, people are going to borrow money to buy real estate as an investment. When that happens, housing prices increase because there's only so much supply. As there is more and more demand to buy these, housing prices increase, which we've seen since 2020, prices skyrocketed. Well, then what happened after that? 2022, interest rates went up. So now you have properties that are worth way more, right? They're more expensive, and you have higher interest rates, meaning people that want to buy houses are like massively limited. They're essentially priced out for housing. On top of that, wages increase over time, essentially, right? And rents increase over time. So a major shift that we've seen in the bottom right is housing prices, both for rentals, right? This chart is for rentals, but also the property prices have vastly outgrown the rate of household income. Things are going up way more, right? They're costing way more than people's income is going up, right? A big part of that is inflation, interest rates, these housing prices, policies, all that. But just simply understand that housing unaffordability is terrible and is not going to get better necessarily. Like there's nothing showing it'll get better, primarily because supply is tight, but the demand is very strong. People need housing. Costs are up for everything, but wages are stagnant or barely increasing. And most importantly, policy is broken. The government is not solving this problem. If we expect hedge funds to do it and big corporate interests, we don't want that. It's better people like you and I, small mom and pop operators, provide this type of housing than hedge funds who literally don't care about the tenants that they have. I'm going to assume if you're watching this, if you're aligned with me, you do care about providing high quality housing to your tenants, and you will take care of your properties and your tenants the way that I do. Corporations don't care, right? I'm not saying LLCs, right? We all have LLCs, but like major corporations, hedge funds, they don't care. It's all about a number for them. Cool. We make really massive returns. As we are making outsized returns, it is our first privilege, but also responsibility to make sure we're providing high quality housing to the tenants that we have, right? Like you're already making massively higher returns than you would otherwise. You're working towards financial freedom, which the tiniest population of our entire world, especially our country, will ever achieve. It is your obligation to then ensure that you're providing high quality housing to your tenants. That's at least my take on it. Maybe that's unpopular. I don't really care. So then how does co-living fit into this, right? So everything's more expensive. Wages are not increasing. How does co-living come into the fold here? Well, co-living is already a large asset and it's only increasing, and it's increasing at a much higher scale than any other type of rental strategy. Currently, or as of 2024, the co-living market was $7.8 billion. Huge number. More importantly, the compounded annual growth rate is 13.5% from 2025 to 2030. What I want you to understand is the big thing here is compounded. Every year it's increasing by 13.5%. So whatever the new number is, increasing by 13.5%. That's why in 5 years it will double, right? It doesn't linearly grow, it compounds. So it will double in size in the next 5 years. Well, to put into perspective, short-term rental compounded annual growth rate is 6.7% over the next 5 years. Understand that their market size is much larger, but the co-living strategy, which has not been as popularized except for the last couple of years, is already 7% of the way there. And this is the global metric versus the US market size, right? It was hard finding the US market size, but close to, let's say, 10% of the short-term rental, and it's going to be growing at a much higher growth rate. Part of that is short-term rentals are already big asset class, right? It already has a big market size, but also it's flat, if not decreasing over time, right? So you will see how this all pans out over the future. Predictions are tough, but this is what it is for co-living. The main takeaway is it's already a huge thing, but it still has so much more room to grow. Just compare it to short-term rentals. And short-term rentals are not a necessity. Short-term rentals are a luxury. They're vacation rentals versus housing, affordable housing, which is a necessity. And even more important when housing costs when everything continues to cost more and people have less and less money to spend on things. It's huge, like it's big. There's a lot of room to grow, and it is growing massively. That's why I'm really trying to educate people as much as possible right now, because for those that go into this sooner rather than later, you have a massive advantage. And to put this into perspective of like, okay, yeah, cool, co-living, like I've never heard of such thing, or yeah, like who would live in something like that? Well, I've done it, and plenty of people have done it. Like a lot more people have done it than you think. It is way more normal than you think. For me, my journey, very simply, as a student, I shared a dorm with 3 people. The next year we got an apartment. We each had our own room in the apartment. Then my then girlfriend, but now wife, lived together in one room and then rented out the other room to 2 roommates. Then we got a 3-bed, 2-bath property that we lived in 1 unit and then rented out the other 2. Like we just split. And the next year we decided, we're going to rent the property ourselves and then charge other people to basically offset all of our living expenses. Right. And then I did that while I was in the military. Right. Well, I was, depending on what branch you're in, the terminology is all different, but we were all living together, multiple people in one room in the barracks. And even when I got off base, what I was doing is I bought a multi-unit property. I lived in one side and rented out the other. And those guys, 3 military officers, were renting out each of the rooms independently. Right. So like that was very common there. And as well as working professional, as I have had to travel a lot for work, I have done temporary rent by the room as needed so that I'm not wasting a bunch of money when I'm traveling independently so that I could just save costs, right? That was a big part of it. This is very common for working professionals, and the massive growth of the pad split platform, including all the markets in which they operate in, is showing how much more common this is, especially for people who need it, right? Like there's my personal anecdote, but for those that need it, and I will talk more about what pad split is and how I leverage them to get a bunch of awesome benefits, like a bunch of data and investment stuff from them. But this chart basically a few years ago when I started had barely any blue dots, which are core markets. It is massively exploded and all the gray dots are emerging markets. So where they are starting to get co-living properties on their platform. So this is only growing. So why the large and continued expected growth? As I mentioned, supply and demand. There are a limited number of rentals and costs are massively rising. One thing I want to highlight is that the main demographic that benefits from affordable housing or the co-living rental strategy, those that rent it, typically make less than $75,000 a year or less. What you'll see here is a chart showing those that make $15,000, 15 to 30, 30 to 45, 45 to 75, all here and below. It's showing what percentage of their income are they spending on housing, right? And you'll see, obviously, as you make more income, less and less of your percentage goes to housing. However, one thing to truly understand is this value, it's 2001, 19, and 2022. It shows this growth. And it's only gotten crazier over the last couple of years as things have gone up massively in cost. What you should understand from here is that people that are making $75,000 or less a year are spending, on average, 30% of their income on housing. With a lot of these guys spending, especially those that make less than 50,000, 50% on housing, right? A lot of people have said, I am tired of working all day, every day to then spend the majority of my money on housing, car, insurance, and just like food, the basic necessities to live. So what they want is an alternative. What they have done is said, hey, I want to shift my spending habit. And this has happened in mass, especially with the younger generations. I want to spend less on housing so I can spend more on eating out, traveling, enjoying life, or like what I did, save that money to invest. That was a big part of my journey, how I've been able to save a lot during my 20s to then be able to invest and scale to the way that I have and have the comfortability to scale leveraging other people's money. Main takeaway, people are spending way too much on housing. They want a more affordable housing option. Rent by the room typically allows people to rent a property at 30 to 40% lower monthly rate than they would if they just got a studio in that same market. That 30 to 40% is a lot of money, right? For every $1,000, that's $300 to $400. It's a lot of freaking money for them to be saving. The shift in spending habit is a big part. People are saying, hey, I'm literally just like out working and I just want to do stuff. I just want a good, clean, safe place to live, a kitchen to cook in every once in a while, a nice outdoor space, whatever. I spend the majority of my time outside of the house. Why am I going to spend all of my freaking money for a house to have a studio or a one bedroom or whatever that I can't even spend a lot of time in, right? I sleep there. That's it. I want good, high quality, safe housing, but I don't need to be the only one living there. They'd rather use that money for other purposes. And regulations are massively favoring co-living. Like government regulations are favoring co-living over other management strategies. In particular, short-term rentals, right? A big reason for why short-term rentals have slowed down and stopped. A big reason for that is, well, first of all, people have less money to spend. And there's a lot of markets that are limiting the amount of short-term rentals or removing the ability to have short-term rentals in those markets. Because you, in theory, are taking housing away from locals to then provide vacation rentals as people want to stay there. Well, that's not, governments have a very hard time, local governments especially have a hard time saying, yeah, let's encourage that more and more over providing housing that is massively needed in lots of markets, affordable housing that's needed. And the government really can't do anything about that. They can allow for more building, but that's a whole slog. Allowing people to take a house and rent it out more affordably is something we're seeing more and more. There are states that have removed like the main limiting factor, which are occupancy laws. Essentially, some areas say you can't have 4 or more people living in a house that are not in a family. Some say 6 or more people. A lot of places have either removed that language so you can have as many people in there as long as you're following like, building codes and like, tenant laws and all that kind of stuff. But a lot of those that haven't necessarily removed it, what they've done is look a blind eye to it because they understand it is a massive solution. Some of the big states that have gone and made it way easier, well, I won't get fully into it, but Colorado, Montana is making ADUs more accessible, so providing more affordable housing. Same with California. Same with certain areas are providing grants for affordable housing. Washington, Oregon, there's a lot of places that are shifting towards, even multiple parts of Texas are making it so much easier. Atlanta, where we have a lot of them, they look a blind eye to those occupancy laws because they understand you're providing a solution that they can't, or they're going to spend way more money to try to solve and probably won't, as we've seen with government, or who's going to do it? Like hedge funds, maybe, right? But the main takeaway, right? I want to highlight, I love the fact that we provide affordable housing through the co-living rental strategy. However, there are much higher returns for investors. You're able to own larger properties in better markets. What that means is you get way better ownership benefits. Not only that, you get way higher cash flow. The same long-term rental that might make you $100 is now making you $1,000 or more as a co-living rental. A lot of mine make closer to $2,000. I have some people in the super investors community that have bought properties that make them $3,000 to $4,000 a month of cash flow. How many of those would you need to be financially free for the rest of your life? It's insane. On top of that, you also get the wealth benefits that are actively accumulating for you as you own your assets. To put into perspective, the higher cash flow. This is a long-term rental in Atlanta, Georgia. This is this example, but we operate as a co-living rental. This is one of 2 examples we'll talk about in Atlanta. This property rents for $19.95 a month. You set aside, right? So you take the way you estimate cash flow, right? The way you calculate it is income minus expenses minus reserves, which include maintenance, vacancies, right? That kind of stuff. What I have here is net operating revenue, right? Net operating revenue is kind of the same, except you're not subtracting away your debt payment, right? Why that matters because it's the same property, so it doesn't really make much of a difference. Same debts, same everything, right? The debt is the same. You're just managing it differently. What matters is your increased income and your increased expenses and reserves. This property is $19.95 a month as a long-term rental. 10% goes to maintenance, right? We set that aside for reserves. There's no utility costs, or tenants cover it all. And there is a management fee of 10%, right? Long-term rental property management fee, because I don't want to be the one to manage it. We pay managers. They do it for around $200 a month. That leaves us with $1,600 a month in net operating revenue. And you take the rest and pay off your debts and all that good stuff. Well, for the same property as a co-living rental operating as an 8-bedroom property, 8-bedroom, 3-bath property, this generates $65.50 a month of rental income in Atlanta. You set aside 6% of your rental income for maintenance, right? It's a lower percentage, almost over double the dollar amount, right? You set aside a lower percentage of your income, but it's always a larger dollar amount. Set aside $400 a month for maintenance, $565 for utilities, so your water, your sewer, your internet, all that good stuff. You're paying for that for your shared housing. And the management is higher because both your income is higher and the percentage is based on the income, but also the percentage for management on co-living is higher because it's more work than long-term rental, whatever. All that being said, because you're making way more, even though you're paying more expenses and have more reserves, you are netting way higher revenue. So a property that would make you virtually nothing, even lose money as a long-term rental, is generating you, let's just assume $2,000 here. This thing would be losing $400 a month as a long-term rental. As a co-living rental, this same property would generate you $2,600 a month of cash flow. $2,600 a month. Yes, there are more expenses when you buy the property. Well, not when you buy the property, but when you renovate, and I'll kind of explain what that looks like, and you furnish it and all that good stuff. However, the cash flow is so much higher that it squashes the increased cost you have to put into renovate and furnish a property like this. And more importantly, because you're able to cash flow, you're able to buy more properties, you're able to buy them in better markets, and you're able to be financially free way more quickly because you're buying bigger, better properties in nicer locations. You're building more wealth as well. So the same property you have to say no to as a long-term rental can generate you thousands of dollars a month of cash flow, 20+% cash on cash return, build you massive amounts of wealth, and you can stack these fairly, right? As much as your operations can handle to buy more and more assets, that's how many of these you can stack. Why is co-living the super strategy? I'm going to summarize it for you right here, like very simply. Co-living is the best rental strategy for single family homes, right? Compared to midterm rental, short-term rental, and long-term rentals. You get 2 to 20 times your returns that you would compared to a long-term rental. Sure, some short-term rentals are competitive in cash flow to your co-living property. However, those properties tend to cost substantially more. They require way more management and maintenance. You have people coming in and out all the time. You're in a hospitality business. You have lots of vacancy, and government regulations are making it harder and harder for you to operate, whereas co-living is getting easier and easier, and we're at the forefront of the co-living rental strategy, like massively expanding. So you could be at the forefront of a strategy like this, as opposed to catching the tail end of short-term rentals, as you've seen a lot of people, including my own mentors, say short-term rentals are dead. I have a few short-term rentals. They still operate well. However, you need to have some of the best properties that are worth a lot of money in perfect locations and have amazing amenities. The mom and pop style short-term rental literally loses money for virtually everyone unless you got in very early and have very low debt costs. Trying to buy them now, you're going to have a very hard time to succeed compared to the co-living strategy. Additionally, because you're able to buy bigger and better properties that cash flow more, like you're able to buy in better markets as co-living that makes sense, compared to a long-term rental where you have to buy a $100,000 home in some random place in Missouri that generates you $100 a month in cash flow. Well, because you're able to buy in bigger, better properties that are worth more, you get higher appreciation. Your properties are worth more and they appreciate more in value because they're in better markets. Your tenants are paying larger debts down for you, both adding to your wealth. Because the properties are worth more and you're renovating them, you also get much higher tax benefits. Additional benefits of co-living. I love the fact that we do get to provide affordable housing. Like, we're helping solve the affordable housing crisis. No matter how non-investors want to think about it and they say, well, you're actually contributing to it, it really depends on how you look at it, right? Because what is the alternative? People are not building affordable housing. People who are making $75,000 a year or less are not able to afford the housing with high property values and high interest rates. What is the alternative? You overspend on a 1-bedroom or you live on the streets? No, this middle ground of co-living at least provides people the dignity to live in a nice, well taken care of property. They get to live there, ideally in better locations, save more their money, and do whatever they want with it instead. So non-investors can look at it however they want. However, the reality is we are helping contribute to solving the affordable housing crisis because government's not going to do it. And I mean, those same people would not want hedge funds to do it, and they will. They completely will do it when they're more cognizant of it or it becomes easier for them to acquire. Additionally, a big benefit, especially right now, if you start in the co-living model like much sooner, there's way less competition. People are still trying to do long-term, mid-term, short-term rentals because they don't fully understand co-living yet, or they're waiting and waiting and waiting. Cool. Less competition means that you can buy more of these more quickly and at lower cost. If you wait 5-10 years from now, or even a couple of years from now, things are going to cost more and you're going to get less returns. That's just common for any investment. Those that get in early adopters benefit the most. Additionally, there's higher accessibility. Since most people are looking for properties that make sense as long-term, mid-term, and short-term rentals, and they don't have the lens of co-living, they're overlooking properties that are great for co-living that you can hop into right now. The competition is diminished, meaning you can buy more of these and at better rates, like better terms. And like there are way more properties that work for co-living than work for midterm or short-term rentals, right? Because those require certain locations and certain things and regulations where you can make this work in like a ton of major markets. Additionally, a big benefit of buying co-living rentals versus like a long-term rental in a small market, it is much easier to own and manage those assets because bigger markets mean that there are more property service professionals, more property managers, more contractors, more handymen, more everything, more of every service that you need to manage your property without you having to physically do the work. There's more of it. More of it means more competition, which means lower prices, which means better quality, which means one doesn't work, you move to the other. Someone who owns in Fairbanks, Alaska, because that's where I started, there's like 3 property management companies there. They all suck. What are you going to do, right? Thankfully, I've got a good one, but if they all suck, what do you do? That's the common issue with these smaller markets. And a lot of people buy in tiny markets because they make sense as long-term rentals. Great. You have 10 small long-term rentals that make you maybe $1,000 a month collect, like in total, like that sucks. That's like a lot of work for very little return. That's where the super investor strategy came from. Tying this back into the super investor cheat code, right? Creative finance, cap raising, co-living. The reason why I love creatively financed investments over traditionally like going and just buying a property using a debt like a DSCR loan or a conventional loan, over buying something cash, over going the BRRRR route, over building things brand new. The reason why I love buying creatively financed investments is, first of all, I get to maximize my deal flow. There's no banks involved. There's no limiting factors. I can go buy 100 creatively financed deals this month if I chose to, right? My limitations are money. Well, great. Learn how to raise capital, so that's not a bottleneck for you. But also your operations, right? You don't want to just buy a bunch of properties that you cannot successfully acquire, renovate, furnish, rent out, right? Otherwise, you're setting yourself and everyone up for failure. So don't do that. Like you should limit yourself on your ability to successfully operate them and then scale as you build your team and can operate more and more of them. But the debt piece of it, I'm not worried about, right? I can go buy as many as I want because I don't have the same traditional bottlenecks of new loans, right? Which require a bunch of paperwork, time, process, appraisals, all this crap, all this extra work that's inefficient. And then to what? Buy a property with 25% down payment and 7.5% interest rates, or go build something brand new, which is going to take me 6+ months to do, or do a massive renovation, do the BRRRR strategy. And then now I bought this property, I renovated it, I let it season for 6 months, and then now I'm renting it out. I have to do the refinance and hopefully it's worth enough. And then I get my money back. So I get to do it. Like, what the hell? Buying properties creatively, I can go buy 10 creatively financed deals tomorrow if I chose to. Well, I can put 10 under contract. I close on them in the next few weeks, right? I mean, some I could buy tomorrow, but there's no limitation. There's no traditional limitations. You don't have to just wait. You don't have to just sit there and wait or do a bunch of excessive renovations, excessive things to make the property successful. Additionally, because I'm buying creatively financed, it costs me less to get into my deals. Well, if I'm putting less to buy my deals, I'm able to buy more deals. Let's say it's $100,000, or like, let's say it's $1 million. Each property costs me $100,000 to get into, as opposed to $200,000. I can buy 5 times as many deals, or yeah, whatever. I don't know. Screw the math. I can buy more properties. So I'm putting less down into those deals. When you put less down into a deal, you get a much higher cash on cash return. Essentially, what is your return on investment? How hard is your money working for you? The $100,000 you invested to buy that property, if the cash flow is the same, but you put less money in to buy the deal, your cash on cash return is higher. That is a massive metric for you to understand. Your cash on cash return equals your cash flow divided by your entry costs. If you have lower entry costs and your cash flow is fixed, your cash on cash return is higher, aka your money is working harder for you. Because I'm buying creatively financed, I'm buying things at 0%, 2%, 3%, 4%, 5% interest rates, most of mine between 0 to 3%. Well, when there's lower interest rates, I'm paying less on interest, I'm paying less debt payments, I'm buying properties that generate me more cash flow than if you yourself had to go buy using a new loan at 7.5%. I should have had a little chart for you, but to compare, it's like 3% to 7.5%. It's basically like twice as much you're paying for the same mortgage, which means you also cannot make deals work the same way that I can if your only tool in your tool belt is traditional financing. Creative financing not only generates me way better returns, but allows me to buy way more properties compared to those who only have traditional in their tool belt. Additionally, because interest rates are lower, those lower rates mean what less money is being wasted each month on interest, more of it is paying down my debts, building my wealth more quickly, right? Not only is the benefit of appreciation from CoLiving, from buying bigger, better properties in better markets, but because my interest rate is lower, my debts are getting paid down faster, also adding to my equity, my net worth. And once again, CoLiving, to very simply summarize, why is it a huge part of the cheat code? Way higher returns and cash flow, way better ownership benefits, way better cash flow, right? So you got to be financially free faster and build wealth more quickly, right? Faster wealth building. And it's way more accessible as an investment strategy right now than anything else. Most people cannot go and traditionally buy a long-term rental that makes sense for them. If you can, it's the tiniest of properties in small markets that don't make a lot of sense. And who wants to own 100, 1,000 Section 8 rentals to then be able to make $5,000, $10,000 a month? That's like crazy. It's like way too much work, and it's not really sustainable because it doesn't scale that way. They need more people on your team, and like it's illogical. It's easy to say on paper. However, it's very different when you actually think about, well, you have to grow a team to then manage and this. Well, the more people you pay, it's eating into your cash flow. You want to get as much return in as few properties as possible that are also building you massive wealth. That's what CoLiving allows you to do. You supercharge it through creative financing, and you you remove the biggest bottleneck, which is your money to buy deals, by raising capital. That's why it's the super investor cheat code. You need to understand all those principles. If you just incorporate one, you're already at an advantage. You do two, you're at an even much larger advantage. You do three, well, that's the whole freaking cheat code. Buy great, creatively financed properties with low interest rates and low money down. Buy them using little to none of your own money by raising capital for those deals, and then leverage the CoLiving management strategy so you can buy more properties that are bigger, worth more, give you more wealth, and give you way more cash flow so you can be financially free more quickly. That's the cheat code. So we're going to talk about some high-level CoLiving, right? I told you I'd give you a CoLiving education on top of that, right? More than just the finances. So how do you choose your CoLiving market? You need to focus on market unaffordability. If you go and buy a property in a small town where rents are not very expensive and there's more than enough housing, no one is going to want to rent your property by the room if they can go buy a comparable, or if they can go rent a comparable studio or one bedroom, or if they can just go buy a property themselves. So you have to make sure it's in a market where it is unaffordable for housing. Most major markets have a massive unaffordability for housing for those that make between, less than $75,000, right? I showed you less than $75,000 a year. Those guys making $35, $36, $37 an hour or less are typically either priced out or paying a ton of their money towards housing. So you want to make sure you're providing a solution to where there is a problem. Don't try to create a solution where no problem exists. So focus on markets that have demand for this type of rental by looking at where are these markets unaffordable. Additionally, if there's a large population, a large percentage is making $60,000 or less, well, those are the guys who need this, right? People making $100,000 or more, maybe it's a nice to have to save money in CoLiving, but it's like a necessity for those making $60,000, $65,000, $70,000 or less a year. So you want to make sure you're catering towards those guys. Once again, CoLiving does not work well in low-cost markets, and you want to ensure that there is a solid amount of lower income workers. And when I say low income, I'm talking about minimum wage, $15 an hour or whatever. I think it's like $7 in some places, which is insane. But we're talking about people who make $30, $35 an hour or less, right? I know it doesn't seem low income, but it is compared to the metric. I mean, that's like the median household income. those are the demographics that are spending a lot of their money on housing, right? A huge percentage of their income on housing. Some other cheat codes: major metro areas are preferred. So go to major markets and major states. So major cities and major states, very common area where things are very expensive, and focus on markets that have favorable occupancy laws. If a market makes it really hard for you to do co-living, why would you want to invest there anyway? Why would you want to fight an uphill battle to invest in a market where the government is making it very hard for you to operate? Focus on markets that have a need for affordable housing, that are major markets, and that make it as easy as possible for you to do this management strategy. That's the main criteria for choosing your co-living market. A cheat code is the pad split platform. These are the major markets in blue, right? They're core markets. These are those core markets in blue where they are operating and have been for a while and have plenty of rentals. Those that are in gray are emerging markets. Those ones are growing. So why try to do all the research on your own? Why not just leverage what they're doing, the number one platform for co-living rentals, right? This is for co-living rentals for both investors like myself, as well as for tenants to find housing. So why would you not use their data? I'm a very data-driven guy. I need data like this to make good investment decisions. It is way easier now than it was even 2 years ago when I started, especially a couple years ago prior to that, when I unintentionally was doing the co-living investment strategy. It's way easier now because of the data they provide. And what you'll see here is not only do they give you the major markets, right? They give you data zip code by zip code, right? You can go for the city like I have here, or you can click any of these zip codes. They're telling me they have almost 7,200 active units and almost 200 coming. They're in progress of being added. So there's around 7,400 units active or upcoming. Well, in the last 30 days, almost 40,000 people have searched for housing in that area. Is that a good market? Yes. So those who say, oh, Atlanta's saturated, there's already too much. Well, there's 4 times the amount of people looking for co-living housing in that market over the last 30 days, and there are available housing units. And a lot of the housing units are already rented out. How do I know that? Because they tell you the average occupancy. 89% of their units are already rented out. It tells me when a property gets operational, it only takes around 8 days on average for the first tenant to move in. Within 30 days, it takes around 30 days to get the property 80% occupied. So if it's a 5-bedroom, you have 4 of the 5 bedrooms occupied within the first 30 days. Additionally, it tells me what are the prices? What on average are people charging? Well, if you have a shared bathroom, if you have 2, 3, 4 people sharing one bathroom, on average, they're charging $175.98 per week. If you have a private bathroom, you're receiving around $266.98 per week. This is the ultimate freaking cheat code when it comes to the data. If you missed it, I'll drop it one more time, but this is your cheat code to being able to buy or to really analyze, choosing good markets and make good analysis decisions on, does this property make sense? Does this market make sense? And then analyzing property by property, does this make sense for me? Especially when you go zip code by zip code. And if you use the link that I provided, you also get linked to the exact rep I've been working with for almost 3 years now, who not only provides you zip code by zip code, she'll provide you street by street, property by property data, so you can compare not just to the general city or the zip code, to all the houses around you. Freaking cheat code. It makes it so much easier when that's the case. I've been using cheat code a lot, right? That phrase, but I wholeheartedly believe a lot of the stuff that I'm providing you is a cheat code. How do I know? Because first of all, it's played massive dividends for me and my family and our financial freedom. However, it's also something that works really successfully for other people as well, right? Like I mentioned in the very beginning, it doesn't really matter what I've been able to accomplish, except for the fact that it is proof of concept for what you can do. All that you should care about is, can I do this for myself so I can achieve these results? Don't worry about me and my cash flow and my portfolio and my wealth, right? That's awesome for me and my family. Use me as a proof of concept. Use all the education, tools, resources, everything I give away all the time for free to help you on your journey so that you can be financially free, right? That's my ultimate goal. Ideal co-living property characteristics, right? Number one thing above everything else is location. Like I said, don't try to solve a problem where there is none, right? Solve problems where they're already saying, we have a lot of demand, right? We have a lot of demand compared to the number of units we have. Here's some core markets. Like literally, here you go. Here's your cheat code. You sign up using that link, you'll get access to this map. And you'll get access to all this data as well. Property size. Some people are able to make 3, 4, 5 bedroom properties make sense for them. However, I like to have at least by the time we're ready to operate and rent out, I like to have at least 6 bedrooms, ideally 7 or 8 bedrooms, and at least 3 bathrooms. So what I look for typically is there's not a lot of 8 bedroom, 3 bathroom properties available. And if they are, they're probably not in the right area, like whatever. What I'm looking for is to convert a property, take those office spaces, dining rooms, and whatever, convert them into additional bedrooms. And a good way to identify that is find properties that are at least 3 bedroom and 2 bathroom minimum and at least 2,000 square foot or more, right? I have a property that is like 1,700 square foot and it is 7 bed, 3 bath, but this was a full renovation, right? So that's how we're able to get so much. And it has a kitchen plus a kitchenette, 2 laundry areas. Like, it was designed specifically for co-living. It's not what I'd recommend the majority to do because there's a lot more work and there's benefits to going the route that I did. I was able to pull all my money out. It was awesome, right? That's the burst strategy. However, I wouldn't recommend that to the majority of people. It's more work, more risk, more things can go wrong, and it takes longer. Focus on buying creatively financed deals that are at least 3 bedroom, 2 bath, 2,000 square feet. Look at those investment opportunities and see, can you make it 6, 7, 8 plus bedrooms? As I mentioned earlier, as a rule of thumb, it's not perfect and it's market dependent, all these things. It depends on how much you buy your property for, all that. But typically what I've seen is when we have 4 bedrooms, right? Like 4 bedrooms rented out, that covers all of my expenses for the property. We're at 5 to 6 bedrooms, like especially like 6 bedrooms, we're looking at closer to $1,000 a month of cash flow. We're at that 7 or 8 or more bedrooms. That's what we're talking about, closer to 1,500, 2,000 plus in income, in cash flow on a property. Use those as general rules of thumb. It's going to be very dependent on your market, your properties, your debt, all that stuff. But that's why I like to have properties that are no less than 6 bedrooms. So I'm making up close to $1,000 a month, but I'm really looking for properties primarily that have very high cash on cash return and are generating me close to $2,000 a month or more. Because you're gonna have a lot of people living in the house, it used to be a big requirement to be close to public transportation, and that still is the case. It is a benefit to have that, but more importantly, it is important to have a large enough driveway and street parking availability so the people that do have cars, your 6, 7, 8 tenants, they can actually live in that unit, or that they can actually park there. And ideally, you don't want to operate in markets that are co-living rentals. You don't want to operate in, sorry, I got a text. You don't want to buy properties that have an HOA, because that means someone else, some people that live there or whatever can change the rules. If it's not restricted, they can change it and make your business model impossible now. Why would you take all that risk? Why would you put other people's money? Why would you renovate properties? Why would you put your tenants in place and then have an HOA tell you can't do this thing? So regardless of rental restrictions and that, I ignore areas of HOAs. Some people do it and they function well, and great. Love that for you. For me, I care about scalability, which means buying great properties in great markets that are easy to renovate and rent out, that have good parking, so less complaints. Tenants want to stay longer. I make sure I provide good quality housing so they're staying longer. There's less turnover. And I'm not dealing with HOAs and other entities that can eliminate my business model, right? I care about scale. You should too if you want to be financially free. Understand that more often than not, property renovations are going to be a must for co-living rentals. So you want to ensure that even if the house itself is not the right number of bedrooms and bathrooms, like there's plenty of 3 bed, 2 bath properties that have 2,000 square feet. Well, they're not using all the space very effectively, or there's just a lot of offices and game rooms and all that stuff. They didn't think, why would someone need that many bedrooms, right? Your goal is to find those larger square footage properties that have good floor plans, ideally converting common areas to bedrooms. Things that like living rooms, dining rooms, offices, garages, things that are easy to convert into a bedroom because that costs you less, right? If it's a dining room and you're just putting up one wall and a door, that's awesome. That's a very low cost conversion, meaning you put less money into your deals. All I do is I just add more often than not non-load bearing walls to close off my rooms. Additionally, you can either build in your closets if you choose to, or have pop-up closets, armoires, whatever you want to do. It depends on our property, depends on the space, and we go between both options. You need to do renovations typically to have a property at the solid enough bedroom size to make co-living make a lot of financial sense for you. However, you still want to do it effectively and focus on things that matter the most, right? Like you could do a full gut renovation to create the perfect house or build brand new. Takes more time, takes more money, takes way, like That's way more work than is necessary to succeed in real estate investing, especially with co-living creative financing. Ideally, spend less time and energy doing the renovations, right? Do the right renovations, but don't make it an uphill battle for yourself if you get this choice. And then one key thing to understand is the maximum bedroom to bathroom ratio you should ever have, like the number of people sharing a bathroom, is 4 to 1. You should never have more than 4 people sharing one bathroom. Ideally, you have no more than 3 people sharing one bathroom. This is one of the biggest things that you see for turnover. The less people that share a bathroom and the bigger the rooms, right? And the more amenities you have, a bed, a desk, all that good stuff, the longer your tenants stay. And if you've done investing in any capacity, minimizing your turnover is massive for maximizing your returns. You don't want people coming in and moving out all the time. It's a hassle. It costs money. You got turnover, damage. Like, you don't want to deal with that. You want to ensure people are staying there longer. And how do you do that? Ensure they have a high quality of life, right? How do you do that? Make sure you're minimizing the number of shared bathrooms, like the number of people sharing bathrooms. Make sure you're taking care of the rooms, furnishing them well, making sure you're designing them, not at the bare minimum, but that it's a comfortable living space. We put good mattresses. We make sure we're taking care of our tenants because, once again, we're getting outsized returns and we want to own these assets longer and ensure we're maximizing our cash flow by ensuring happy tenants that are not moving out all the time, right? So the renovation is a huge part of it. A big part of that as well is when you're creating your walls, don't go cheap, insulate those walls very well to minimize noise and get the heavier doors, right? Don't get the hollow doors, get the heavier doors that will minimize noise as well. That's a huge factor in all this. So the cost to acquire co-living rentals. I'm not going to go deep into this. However, I want you to understand the comparison. Property, like whether you buy a long-term, mid-term, short-term, whatever, it's all the same. Like the cost to buy it is going to be the same regardless of your management strategy. If you put a down payment, you have agent commissions to pay, you're paying an agent, you have a wholesaler, say you're buying a deal from a wholesaler, you have closing costs. That's all the same. It's just based on the property that you're buying. That doesn't matter based on the management strategy. What does differ is the additional entry cost. Whether you're doing short-term, mid-term, or co-living, you're more likely going to renovate the property to convert it to the right style. For short-term, it's like amenities, game rooms, whatever. Mid-term, you don't do a lot of renovations typically, but co-living, the main renovation is to convert common areas into bedrooms, right? That's the main thing you're going to renovate. Additionally, you're going to furnish your properties. With co-living, depending on where you're operating and what's the market standard, you partially furnish it or you fully furnish it, right? You fully furnish the common areas, you partially furnish the bedrooms to give it some individuality, some customization for your tenants. It's very different for short-term rentals, right? It costs typically more to renovate a co-living than it does a short-term rental. However, the furnishing costs for a short-term rental vastly, they're way more expensive to furnish a short-term rental than it is to furnish a co-living rental. It's a very different thing. And then your property reserves. You want to make sure that you have enough property reserves so that once you're done with the renovations and furnishing, like once you buy the property, you have enough time to pay all your debts and expenses while you're renovating, while you're furnishing, and while it takes you time to rent out. We saw that one example. It said 30 days to fill up your house 80% of the way. A lot of mine in Atlanta, similar property, we'll get within 30 days, we'll get 100% fully occupied, right? So it really depends, but you want to make sure you have reserves set aside for that because it's going to take time to renovate, furnish, and rent out. So those are the different entry costs that you have to account for when it comes to co-living or a more advanced strategy than long-term rentals. With a little bit of a comparison between renovation and furnishing costs for co-living versus short-term rentals. Additionally, when it's a long-term rental, you typically do not have to cover any additional expenses, right? You're paying your fixed expenses, which is your debt, your taxes, your insurance, right? But your tenants are more often than not covering all of the other utilities and other expenses, right? You still have reserves. You still have to pay a property manager. You still have vacancy, you have maintenance and CapEx, but the additional cost for co-living, just like short-term and mid-term rentals, or even a furnished long-term rental, you typically, because it's a more advanced strategy, you're going to pay more for insurance. You're going to cover the utilities. So water, sewer, gas, electric, garbage, internet. If you cover the landscaping, which I recommend that you do, it leads to less tenant conflict. If you get the house cleaned every once in a while, like quarterly, we'll get common areas cleaned, sometimes monthly. It just depends on the property and like the level of property. Like there's different properties, right? We have some that are short-term rentals that we bought, failed short-term rentals, and converted them into luxury style co-living or rent by the room rentals. We have it priced in which we'll clean up the common areas and all that. We got a pool, all that good stuff. But then a lot of ours are just for working professionals that make, right, 30 to 60,000. They'd rather have lower rent than have us clean up areas, right? If you're going to provide any supplies, toilet paper, paper towels, cleaning stuff, up to you. Ultimately, you got to account for those expenses. You're typically going to pay more for management. This is depending on if you're using the PadSplit platform, right? And I haven't fully got into that, but PadSplit is not just this great place for data. What it really does is it's the equivalent of Airbnb for short-term rentals, right? So what PadSplit does is it's a platform in which tenants that are looking for co-living housing can find it. And PadSplit is spending a ton of money every single month marketing to more and more people, educating them that co-living exists, right? You use the platform. They don't manage your property, but you pay the platform if you list your properties on there and you're getting tenants through there. You pay a fee, an upfront fee, like when a tenant moves in, as well as an ongoing fee. And basically what it does is they help you place tenants. They do the filtering and, they give you the data on the tenants, all that good stuff. You do your guest communications. You communicate with them through the platform. You collect rents on the platform. They handle like the lease side of things, their membership model. Like I said, the guest communications is done there. But you still have to manage the property. If you need to move someone in, someone needs to move them in. Someone needs to handle that. If you need to coordinate cleaning, if you need to coordinate repairs, someone needs to do that, right? They do that. You have to do that yourself. So either you self-manage it or you pay someone to do it in conjunction with PadSplit, or you do that completely independently and you have a property manager do all of it. It's up to you ultimately what route you want to go for management. Additionally, we have vacancy and maintenance and CapEx, right? So as I mentioned, maintenance and capital expenditures, those are reserves. That's always going to be a higher dollar amount than it would be for a long-term rental. Not because the capital expenditures are covering, like replacing your roof and things like that is going to be higher. That's going to be the same, regardless if it's rent by the room or long-term. You're going to have more maintenance issues with more people in there. More things are going to come up they're going to have to take care of. So you're going to have more maintenance expenses. All of the capital expenditures, the big stuff, is not going to be increased substantially. And then your vacancy reserves. So the difference, you cover expenses, you have more management fees, and you're paying similar percentages of your income towards your reserves. However, it ends up being a larger dollar amount. One thing I really do want to highlight is for those of you that are very intrigued in the co-living model, I have an awesome workshop coming up in San Diego at a just incredible property of mine where I will help you I will literally give you everything you need, the step-by-step roadmap, all my tools, resources, everything to buy your first or next co-living rental in 90 days. This is a 2-day workshop in person. If you register, you get all the recordings, you get all the tools and resources that come. Even if you can't make it in person, it's like freaking people charge $10,000 plus dollars for this co-living stuff, right? For the resources I'll be providing. For $997, you can attend in person or just buy it so you get the virtual resources that come from it. And what will that help you do, right? It'll be this on steroids, right? We're going to go deep into how to find properties, how to analyze properties, what makes good investments. We're going to help you model out your path to financial freedom. I have it all here, right? The foundations like mastering markets, deal analysis, off-market deals, creating great offers, renovations and design. So you get my furnishing checklist. Like when we furnish a property, I'm very systematic, right? We use similar furnishings for the properties. We renovate similarly. You'll get access to all that stuff. Renovation checklist, furnishing checklist, co-living, investing calculator, all these tools and resources, plus multiple days of education and in person. More importantly, this is a small group, right? So what you'll get is you'll also not just benefit from being with me, but other real estate investors that are either actively doing co-living, looking to scale, or those that are looking to do co-living, where you can find partners, build relationships, create accountability. It's the all-in-one, and you'll get access to that. Plus, like I said, you'll get access to the recordings, tools, and resources afterwards, whether you're there in person or not. I got a whole workbook for you guys. So if you want to do that, the price is actually like, I think it was $2,600 or something like that. We had sponsors come in. So what I did was I got sponsors. I got some amazing sponsors, PropStream, Relay, and Fractional. All 3 companies that I utilize extensively for my investing journey. I'll even show you, I'm going to break down how you can utilize them to massively fast track your path to building a portfolio to financial freedom. But this price is like 60% off right now. Why? Because I got those sponsorships, and instead of saying, okay, cool, it's money for me or whatever, what I did was I just made the tickets cheaper for everyone. I made as many tickets as possible, as cheap as possible, to still ensure that I'm making enough to make this worthwhile. But my goal is not to just maximize my returns on this. My goal is to take the sponsorship money and make it cheaper for you guys. Thank you to our sponsors. And for me, for making it, directly attributing it to make it cheaper for you guys. That's what I did, right? So I made the tickets cheaper for you guys. So if that's something you want to do, feel free to come. It'll be in San Diego, September 20th to the 21st. We also have a massive meetup in San Diego on the 19th of September. So please show up to that. That'd be awesome. I'll have a post more about it. Additionally, I have a bunch of free tools and resources for you, right? I say my Wealth to Real Estate School community. I have literally a free community called Wealth to Real Estate that you can sign up for. And what it does is it provides you massive benefits. It provides you free courses, free tools, free trainings, and I will show you briefly what that looks like. This recording, I'm taking it off afterwards. I'm going to be on YouTube. I'm going to put it in the Wealth to Real Estate community. In here, there's over 1,600 real estate investors, right? That's insane. I can't even believe it. 1,600 people plus get massive free value from me consistently, including trainings like this, but they get to communicate with each other, engage with each other. People have sub-2 deals that they're selling. This, my boy Renee over here, he provided 200 freaking books from Alex Hormozi's $100 million money models books in here. We have a list of ebooks. We have all these good things. You get all this stuff, right? We communicate, answer questions, all that good stuff. You get access to that in here. Additionally, free trainings. So I'm going to be shifting this around a little bit, but there's a bunch of free trainings and tools and resources to massively help you on your journey. Who's giving away all these free courses? And these aren't just like these are like full extensive trainings, like on these topics. It's to provide you as much value as possible in your investing journey, all for free. If you then decide that maybe you want to be a super investor, awesome, right? That is more for those that are existing real estate investors who have the financial means, who have the time, and who have the, let's say, the mindset ready to scale to financial freedom. I literally help you do that step by step through the Super Investor Blueprint. Like, I give you all the tools, resources, and everything, but to do that, you have to apply. I do not accept everyone. That is not something that I am actively doing all the time. If you think you are a good fit for that,